Good morning, ladies and gentlemen. The Chop Fest continues, and is it the calm before the storm? That's the question we're going to be trying to answer today. And this week can pretty much be summed up in one simple image. So I hope you got a laugh out of that. The week has basically been a Chop Fest completely. The S&P 500 failed to make a weekly newer range. We basically closed inside the body of the previous candle and actually right under the previous month's high. So we're just basically sitting in the exact same spot we started the week. Your range on the week was 0.25%. So it was absolutely horrible from open to close. So basically theta burned to the max. We burned everyone's options. Screw your calls, screw your puts. Everyone that wasn't an option buyer this week basically got burned to a crisp if you're doing it on the S&P or anything really related to S&P. Now, NASDAQ actually made a new weekly higher high. We continue to make weekly higher highs. However, we are starting to maybe see some weakness in the NASDAQ. The previous week we had a hanging man candle. Now we have a doji. Historically speaking, these are signs for either consolidation for a bigger move, or now I say bigger move, it could be to the downside and it could be to the upside. Seeing how you basically have gone on this massive rip, the disconnect between the market and the Fed, where the market right now is pricing in a 96% chance of a Fed pause in the next meeting, when the many Fed officials have basically said meh to the CPI data. We had Bowman come out yesterday, and we'll cover that shortly, that basically saying that she was unimpressed by the CPI data. It was basically saying, like, why are you guys cheering about this? Like, it's 0.1 of a decrease. Hello, anyone home? But I digress. The S&P 500 basically, again, on a weekly basis, just went absolutely nowhere. We still failed to break out the range. So my suspicion is, because you're starting to see volume kind of leveling down, we could be heading for that big move up. Is it going to be the upside? Is it going to be the downside? I have absolutely no idea. And anyone telling you that they have a clear idea of where this market's going to go is BSing you completely. The market is going to make a big move. That's where I'm seeing here because of all this consolidation. Well, it gives me a little pause, and why I lean more towards the downside, keyword lean, don't guarantee, guys, is that tech is basically going upwards while you have the Russell that is just making a weekly consolidation down here. Could be a classic basically bear flag pattern on the Russell to break to the downside. On top of, if we zoom out on the Russell, you can pretty much see a massive head and shoulders forming on the Russell. So we definitely have to be keeping an eye on it. Russell is 2,000 companies, guys. It's going to give you a sense of the broader market. And again, you can't have a bull market, and I can't stress this enough, without regional banks and banking sector. KRE, Dookie closing lower than we opened on the week. Red week, we haven't actually taken this low out here yet, which is from the FRC collapse. Now, if we take that low out, the carnage is going to start. But however, you're trending downwards. You haven't broken the downtrend on KRE. It's as clear as day. Until you break this downtrend right here, you are pretty much going to go absolutely lower on the market. And I do not believe you can create a new bull market on this S&P. Everyone wants to run into tech like the .com bubble. So let them be it. We all saw how that played out. XLF, which is the bigger banks and basically a conglomeracy of the bigger banks, basically bashing its head against the 50 daily moving average once, twice, 3 times. So it's just been a crappy week, guys. You gapped up on XLF, actually closing basically lower than the previous week. So, you hear more bad news. You're not. The bank sector is not making higher highs. So therefore, your whole market is not going to make higher highs until this resolves itself, until we see KRE break this downtrend. And I'm going to say at least get above the 3940 region before I even say that we're going to be advancing to the upside. Now, let's just quickly recap the news from the week. On Monday, we had employment trends, nothing really much. Wholesales didn't move much. A loan survey. Tuesday, we had the Williams speaking, and he basically gave you the reality check, as I would call it, of there's still more work to do. Inflation is still too high. Why would you guys be thinking they're going to give you a pivot next meeting when they're saying inflation is way too high? Now, mind you, he did not see the CPI report that was coming out, and he did say he was going to be data dependent. So we haven't heard Williams speak after saying those things and how he would take the CPI report. So we're going to have to be on the lookout for that. Then Wednesday, Big Daddy CPI came out, and we covered this in the live stream. The market chose to run on this one number, that inflation came in 0.1 lower than the year-over-year number. However, core is still staying basically stagnant. 0.1 decrease, and I'm going to say CPI is staying stagnant, guys. A 0.1 decrease in CPI is not something impressive. You went from a 1% decrease to 0.1. That's basically me going 100 miles an hour and then slamming on my brakes going to 20, but saying that's breaking the land speed record. It's not. You're slowing down. It's not good news. You don't want to do that in a race. So overall, the month over month keep going up, and eventually this trend is going to have to come clashing with the year over year number. You cannot have a month to month increase and have year over year keep going down to get to 2% goal of the Fed. It's just not going to happen. So this number has to start going down or having negative prints on the month over month in order for year over year to come down. And guys, remember, CPI was changed to take the previous year, not the previous two average. So therefore, you are building 4.9% on top of the world-shattering record 40-year inflation. Just let that sink in. You're building it on a already compounded number. You tell me if that number is bad or good. So then Thursday we had PPI, came in basically the same like CPI, is now trending basically the same. The cool thing about PPI is that you actually had a decrease on the month over month number from what they were expecting. However, last month you basically had a negative number that was revised higher, so bad news, and you went from a negative number to a positive number. So the month over month still increasing. It's beating their expectations, but it's still decreasing. You had Waller speaking as well, and basically just more of the same. Then again, I mentioned Bowman basically saying that unimpressed with the CPI number. So this is a voting member of the Fed. You basically have to take what they say, not with a pound of salt, but with a couple grains of salt, but also listen very carefully to what they're saying, because they are going to be one of the people that's going to be shaping the decision of the FOMC. And if you had members that were basically hinting from Powell's speech that they were not keen on a pause yet, or a decision has not been made on a pause, and you have the same opinion now going into it, why would you expect something else? It's the literal definition of insanity, doing the same thing and expecting a different result. So those two worldviews are going to have to clash in the future. And like always, we go over the net speculative positions for you guys. As you can see here, they went from 355,000 to 376,000. So not only have we basically slammed net speculative positions higher, this is the most short they have been in over a decade. Going back, you have to go all the way to almost 2008 to get this short during a non-crash period. Meaning you weren't this short when you were falling in 2008. I believe the record was like 480,000 net speculative positions or some ridiculous number like that. I have to look it up exactly, guys. But that was when the market was falling off a cliff. The market is not falling off a cliff. So either there's a lot of smart people, and I say smart people because these are institutions basically saying, yeah, we're all dumb and we're going to lose all our clients' money, that have made money for the past multiple decades, or there's a lot of dumb retail traders that have caused a lot of these crashes before. One of these two worldviews is basically, gonna come true. One of them's not. You can use your own judgment of which one you think I am leaning towards. But however, this is extremely important. 376,000. We're basically on the precipice of 400,000 net speculative positions. So that crash leg's coming soon. I'm just going to make that statement right now. Either these people are so dumb, or that crash leg's coming really, really soon. And all it's going to take is probably one more bank or debt ceiling or any list of black swan events. But yet the bulls want to keep buying. We'll see how that turned out this week. We're going to have Fatal take it away with the biggest winners and losers. And then I'll be back for the key levels on the market.
So as you guys can see on the 5-day, the S&P 500 was pretty much just straight line. Like, it wasn't even up. It was barely down by 0.37%, as you guys see here. And, well, it's actually fairly surprising overall. It feels like the market just has no idea where the hell it's going. So let's jump now into the S&P 500 heat map to see what were the biggest losers and the biggest gainers in each sector. Starting, guys, with the technology sector. You know what? It's actually fairly red. I was not expecting it to be this red. And by the looks of it, guys, the best performer is the company FSLR for solar, gaining a whopping 29.73%. And the worst performer would be none other than, well, you know what? I thought it was going to be Intel, but you know what's actually Skyworks Solution, losing 6.7%. Looking into the communications, guys, I mean, this one, you guys are seeing it right there. It's the biggest one. Google, biggest gainer, just ripping, absolutely ripping, 11.31% to the upside, guys. Absolutely massive. You had other ones like Netflix, which also gained 5.31%, and News Corporation gaining almost 6%. However, the worst performer would be the company Dish Network, losing 13.5%. Also, Paramount lost a significant amount as well, almost 11%. And Disney, after the abysmal earnings, guys, if you guys haven't checked out my fundamental analysis on Disney, make sure to check it out. I mean, it'll be fairly surprising if you guys see what the calculator actually put this company to be valued at. It's absolutely crazy. But the company lost 8.5% on the week as well. Looking now into the consumer cyclicals. Very, very red sector overall, except for just a few companies. And in fact, the best performer was the company Tapestry, ticker of TPR, gaining 5.67%. Also, guys, I mean, you got Amazon gaining 4.36 and Etsy gaining 5.2. So overall, it's still a really red sector, as you guys could see. Worst performer would be none other Norwegian Cruise Lines, losing 6.3%. Looking now into the consumer defensives. Very, very flat sector. Honestly, nothing really happened here. Well, best performer, it's actually really difficult to find, not gonna lie. But by the looks of it, guys, the best performer would be, actually, yeah, it's actually the company Dollar Tree, gaining 2.09%. And the worst performer, very easy to find, Tyson Foods, losing 19.5%. They did have earnings on Monday. Maybe one that we may want to take a look at, guys. Tyson was already a company with a really decent valuation from what I can remember. And the fact that it's already fallen to 19.5% already just this week might present itself as a pretty decent buy. And of course, the financial sector just cannot get a break. Another week of losses. Best performer here would be the company, guys, PGR, the Progressive Corporation, gaining 3.02%. And the worst performer, this is just all over the place, honestly. I mean, you got massive ones here when it comes to the insurance life, losing a significant amount. I mean, the guys, the regional banks are just completely like on a tailspin at this point. I mean, you can even see that the worst performer here in this industry would be the company CMA, losing 12.27%. However, in the whole entire sector, the worst one was none other than PayPal, losing 17.71%. Looking now into the healthcare sector, very, very, I was going to say very, very 50-50, but, you know, coming down here, this is very, very red. Nonetheless, though, best performer would be the company STE, gaining 11.5%, and the worst performer would be, by the looks of it, it's the company Perkin-Elmer, losing 10.45%, with other ones losing a significant amount as well. I mean, you got DHR 6.23, GEHC 5.15, Moderna 5.65, Baxter losing 7.7. So overall, guys, I mean, everything here was just down here at the bottom, very, very bad overall. And actually, no, I am so terribly sorry. I am so terribly sorry for that. No, the worst performer is Catalent, losing 31.18%. So I take that back. I really do take that back. And yeah, the best performer is still STE. So yeah, never mind. Worst performer is Catalent, losing 31.2%. Looking now into the industrial sector. Very mixed. Slightly leaning more towards the red side, though. You can see here the best performer would be the company. It's actually fairly easy to find. The company TDG, gaining 3.7%. And the worst performer, by the looks of it, it is the company, yeah, SWK, Stanley Black & Decker, losing 6.82%. When it comes to the REITs, this one definitely leaning more to the downside. You can see most of these are in the red. Best performer would be the company CSGP, getting 1.03% only, and the worst performer, by the looks of it, it is none other than the company Boston Properties, losing 6.76%. Looking into the most defensive of all sectors, the utility sector. Aside from one, everything here was pretty bad. Best performer, NEE, gaining 3.25%, and the worst performer, from what it's looking like, guys, it is none other than, actually, AEE, Amarin Corporation, losing 3.04%. Looking now into the energy sector. Okay, at least we're no longer a complete Ruby. I think it was a complete Ruby last week. We got, guys, the best performer, none other than, well, yeah, it's none other than EQT, gaining 3.4%. I mean, there were only 3 green companies, so I'm just going to say them. EQT, 3.4% up. Valero, VLO, 3.25% up. And Marathon Petroleum, 2.79% up. Aside from that, everything else was massively in the red. In fact, the worst performer, guys, would be the company Devon Energy, losing 5.64%. And lastly, when it comes to the basic materials, wow, if they were red, they were really in the red. Best performer would be, it's actually really easy to find, the company ALP, gaining almost 9%. And the worst performer, it is, by the looks of it, guys, wow, it is actually IFF, International Flavors and Fragrances, losing 13.8%. Overall, massive red week, with just a few plots bringing it up. Like, that's really it. There really isn't much of anything else. Just 1 or 2 companies holding this thing up. Obviously, Google, Amazon, Netflix, what's another one over here that's keeping it up? And I guess for solar. But overall, guys, this thing is just, you know, it's definitely heading more towards sideways territory. So with that said, take it away, Mike.
All right, guys. So make this as sweet as simple as I humanly can for everyone. The weekly range that you have to break, and we're going to start off with S&P. The key level, and I'm actually going to get rid of this 412 before, is 408.87. That is our weekly lower low. And the real carnage, as I would say, is when you start breaking this double bottom here at 403.78. So I'm going to say 408.87 is a pivot. I wouldn't necessarily be the, hey, go all in bearish situation. That's when we start breaking this level down here. And that means that we're breaking our 50 daily moving average most likely with it, because that's going to bump up to that level this week. So if you're going to have that bearish week, it's pretty much the perfect time to set it up. You have a double breaking of support. If you manage to break the backs of the bulls on that level, head lower, that will be a strong move for the bears. Now, the flip side is that you come down here, bounce off, that's a triple bottom, and now the bears are absolutely going to invigorate the bulls. And the bulls are going to just take a couple snorts of that hopium, and they're just going to keep running it up. Now, let's say they take the snort of the hopium now. They think this is the greatest market in the world. So if we swing up, you basically have to break 417.62, which will birth the new bull market for the S&P 500, basically closing above 418 on the week. So the stage is pretty much set for the ultimate showdown in the market. The bulls or the bears is basically this week a step up or shut up, is basically as I'm going to call it. Now, what I don't like for certain things on the S&P 500 is you're having stagnation to the upside. You're diverging from all the other markets where tech, NASDAQ, S&P, IWM, Dow, they're all not trading cohesively. Usually you'll have all of them trend together, whereas now some days S&P is leading, next day is tech leading. It doesn't show cohesiveness in the market, which is traditionally seen in bull markets, aka the financial sector is basically a boat anchor. We covered it with KRE, and I'm gonna dive in today a little bit into the financial sector just to give you guys some levels there that I think is going to be extremely important to pay attention to, because they're going to be the levels that will determine where the market goes. Again, you cannot run and create a bull market with a financial sector in ruins. It services all 11 of the other sectors, so therefore you can't just you can't have that. It's just plain and simple. We can argue the point till we're all blue in the face. It just simply can't happen. Look at .com bubble. When all the .coms ran and left everyone else, look at that massive bubble. Case in point. So with the S&P 500, basically the weekly range is you got to break above 417.62. The reason I'm not saying we're looking at this area right here on the weekly high of 1454 is because I'm going to make those an important lines, because you need to break out of this consolidation period, and that's really going to determine which way we go. So 408 to 414 is your basically range you have to break on the S&P to give you a sense of direction. 417.62 and 403.78 is basically a area that you break and hold in order to determine the next several weeks of trading. That will give you your trend. Right now, you're in the chop box. And if we look, what our potential to the upside is 1.46%. To our downside potential is 1.83. So slightly skewed to the bear's favor from a profit to loss ratio. However, would I be taking the trade right now? No, because it's 1-to-1 risk to reward ratio. I basically be looking to, if I'm inclined, which I am, I have short positions on the market right now with vertical spreads, because I'm basically taking advantage of the chop box. I don't necessarily need the market to go down in order to make money. I basically use it as an advantage to, if you continue this chop box, which could very well happen going into the debt ceiling debate where the market's not going to decide any movement. That's the other thing, guys. You don't have to break this box. You can, the next 3 weeks, go stagnation sideways. There's a reason they say sell in May and go away, come back for Labor Day. But regardless of that, that's your ranges that you basically have to abide by. And just look at the daily. The daily is basically, we've sat in this chop box and basically pivoted around 412 roughly. With some of the interesting thing is, if you look at the volume, the most notable thing on the daily is higher red volume than green volume. If we go into the hourly view, we have the same story. We see an accumulation of red volume, with the first green volume occurring on the close on Friday, which they basically had to buy the close. Like if we go into the 15-minute, look at this, guys. They basically came down to a key level and they had to basically get back above that key level. So the bulls didn't necessarily want to buy this. They had to, because if they would create more downside potential. They didn't want to let the bears have such an easy point to break that 408.87 on the week. So it's just a easy setup for everyone. And, you know, you got to just wait and have this trend out. This probably has been the most choppy market in existence, as I would call it. And again, you have that head and shoulders forming on the S&P. So more things just showing bearish signs. IWM head and shoulders, S&P head and shoulders, NASDAQ stagnation with a 2 weekly candle showing bearish signs or weakening. You got all these things on top of net speculative positions. I'm like, at some point we gotta recognize that there's maybe a skew to the downside. I know the bulls want to just take a whiff of that hopium, but I'm like, well, you got a crap ton of black swan events that could derail your entire rally. Now, I want to be bullish on the market, guys, but when you're flirting with negative GDP the next time it prints, when you have a debt ceiling issue, you have bank failures, you have all this, maybe it's not the best time to be an investor in the market. And when I say the market, I mean like the S&P, NASDAQ, tech, like Apple, Amazon, Google, NVIDIA, chips. Like right now is maybe the time to go put your money into bonds when the 1 month's paying 5.4%, which hasn't happened in almost probably 3 decades. It's basically 0.5% per month. So unless the S&P is gaining 0.5% per month on average from where we are now to the end, if you were in the S&P, let's say you take advantage of the 7% run and now put it in bonds and just guarantee yourself the remaining high percentage that S&P returns historically, and just take none of the downside. That's the thing. It's 0.5% for zero risk, guys. And everyone that wants to throw it in the comment section below of what if the government defaults? If the government defaults, your S&P is going to hit triple circuit breaker days every single day until that solution resolves itself. So let's not even go there. NASDAQ now. So basically, NASDAQ, you had a weekly higher high. So it's basically the range you got to break. 321.32 for the low, and that's when it starts becoming bearish. And for me, it's really this trend line is when we start breaking down. And really, like, you start accelerating once you break 313.04, which to the upside potential, let's see, you from where we are now, you basically have 0.6% to the downside, 1.1%, so almost a 2-to-1 risk to reward. So again, I'm positioned this way, guys. It's a 2-to-1 risk to reward to the downside. I'm betting the NASDAQ is going to go lower. I'm seeing weakness on the weekly chart or signs of weakness. I'm not betting huge. It's only a small percentage of my portfolio is in the market right now, 20%. So you basically have to be cautious of where you're going to go with this. Would I be wanting to buy near this massive push up? No, not really, especially when the S&P and Dow and IWM are trading like complete garbage. Now, for 321.32, once you break that level, my first instinct is going to be looking at this trend line. This trend line is basically drawn going back to, I'm going to jump to the dailies to show you guys, from our March push up that we've basically touched twice here. This was on the April around FRC and SVB times. This April mark was around probably when FRC was occurring and basically pushing back up. So all these things just combining together is where I'd be looking to break this trend line, and then I'd be looking again at the 50 daily moving average. That's going to be your key pivoting point. Once you start breaking moving averages, that's when the landslide comes. I do believe it's going to be a black swan event that causes you to basically break that. It's not going to be the black swan event that causes the crash leg, in my opinion, but with tech, I'm definitely going to be looking at a black swan event to break one of the key supports. The other thing is volume is slowly decreasing as price is increasing. This is bearish. You don't want to see that. The weekly graph, if you look at it, basically, if we scooch it over here, you can clearly see that from this, you had a massive move up with price, with volume completely going down. This is a standard volume divergence. It doesn't play out in the bull's favor. I'm sorry, unless we have a huge catalyst event that's going to propel us to the upside, which is there going to be one? I really don't know, guys. So with all that, I would be betting to the downside. I would rather see volume going down, price stalling out. That's when you go short, or basically the way I do shorts, I do vertical call spreads to take advantage of theta, especially when the market goes sideways to make money. And then you get the run down. That's when you go bullish. You go bullish when you basically want to buy the 50 daily moving average, not buying up here. Like if you're going to be bullish, right? I'm trying to give you guys the both scenarios. But again, consider all the possible black swan events. Yes, you can miss out on the rally. I know. Go put it in bonds. Go to sleep. Every month, if you think the market is going to basically flip on itself and go from crash leg to consolidation to running back up to all-time highs in a month, you've lost your damn mind. The crash leg will probably take 3 months. So by that time, you cash out of your bonds, you buy everyone's stuff for 80% off, and then go have a nice merry life for the next 20, 30 years, basically getting paid dividends and everything. I'm trying to make the case for bonds, guys, because the case hasn't been made for bonds in 40 years because the yields on the 1 month were basically 0.3%, and now they're like 5.4. So do the math yourself. 5.4% annualized risk to zero risk versus the market, which could make you have heart palpitations every day you look at it. Me personally, I'm looking at bonds. So I think I've given you guys enough of the key levels. I'm going to jump over to VIX, dollar, and the yields. And I'm specifically going to go over to the yields real quick just because we touched on this. The 3 month is paying you 5.2%, and TradeView actually doesn't have the 1 month yield. So I can't really show you that, but the 3 month, 5.2%. The reason I know 5.4% on the 1 month, because I'm through my 401k and Fidelity, that's basically where I see it, and I take a look at it just to see what it's doing. 6 month, 4.94. And again, when these two things get repriced of cuts, because remember, these yields, the 6 month and 3 month, are being suppressed because of the perception that the Fed is going to cut. On top of the turmoil with the on top of the turmoil with the banking sector and the debt default ceiling, and the turmoil with the debt ceiling is basically making everyone run away from one month bonds, because it's just they don't want to necessarily hold it because of that risk reward. Big institutions, they're basically going and they're buying 3 and 6 month bonds rather than going into the Fed repo facility. So the yield curve is so horrendously inverted that it's near a 2% inversion on the 3 month to 30 year. It's just, when you look at it, it's like, why would you not take advantage of this? You got to chase yield, as they call it. So on the dollar, you have a descending wedge, which is bullish, and you're basically having a massive push up. If we jump over to the daily just to see if we got above the 50 daily moving average, we have. So again, the bond market and the dollar are a huge market. They're multiple times bigger than the stock market, so they will front run events. The dollar is above, have massive push up, probably with volume, pushing up the 50 daily moving average, closed above it. That should put downward pressure on the market, and basically the market hasn't really reacted to this. Now, we should see continuation, or we could digest this big move around here, basically consolidating around the 50 daily moving average on the dollar, but this is showing a bearish sign. So now you have net speculative positions, you have the dollar, you have yields. Everything is screaming that we could be heading lower. I say could, guys, because anyone that tells you has to is full of crap. However, it's a probability game. You basically have more probability right now, based on what I'm seeing, to go lower versus go higher. We showed the tech has a 2-to-1 risk reward ratio to the downside. And finally, the big kahuna, VIX. VIX has basically been stagnating around here and forming basically a nice wound up coil. So VIX being near lows that it doesn't like being around, with the potential to have a big spike up. What does that mean for the market? Again, risk to reward, downside to upside potential. On the weekly, it basically actually closed inside the previous range. So are we going to have a doji here to the downside, or are we going to have a doji to the upside on the weekly? I really don't know. But people are not running for insurance, meaning if people are caught off guard, everyone is going to be running to VIX like a madman. So keep an eye on VIX, because if the dollar keeps where it is, VIX starts spiking up, it definitely could spell bad news for the market. So with that, guys, we're going to jump over to any news catalyst that we have possibly, and then we're going to conclude the video just because Fatal had some other obligations he had to be at. So kind of getting a nice concise video format this week. So starting off with Monday, we have Empire State Manufacturing Index and Kakashi speaking. That Fed member is more of a dove from previous rhetoric that I've heard from them. So just keep an eye on that and keep that in mind, speaking before the market opens. But then again, we've seen doves come out and basically say, no, screw your pivot. So definitely going to be on the lookout for what they say. May just walk the line like every Fed member is pretty much doing, because they're terrified they're going to sway the market one way or another. Tuesday, we got core retail sales and retail sales. So we're definitely going to be on that, along with industrial production. That could be a mover, because it's going to play into is GDP going to come in worse? How is it going to play out? And oh boy, we have Fed Williams speaking on Tuesday. So I'm really wanting to see if he mentions anything about the CPI report. That, remember, he was speaking the day before the CPI came out. So if he hints at that he was unimpressed by the CPI, similar to how Bowman was, it's really going to be a turmoil for the market, because this guy can sway the whole entire Fed group. So we just have to be cautious about that. We have building permits coming in and housing. So this will show the strength of the housing market. I do expect it to basically come in flat like they're predicting here, maybe just stagnation. Or I think housing is basically going to go up, down, up, down, up, down, just stagnating around this area, not really having large swings until maybe something starts breaking. But I'm not an expert on the housing market, guys. I seldomly understand it, and it's something that, go do your due diligence about that. I'm just giving you my opinion on it. Thursday, we have initial jobless claims expected to come in below expectations from the previous month. So again, stronger job market. And then Philadelphia Manufacturing Index expected to come in negative, but basically not as negative as before. I work in manufacturing, guys. I think this number is going to come in about where it was previously because manufacturing is just shrinking in the United States. The demand is basically falling off a cliff. And then Friday we have Williams speaking again. Boy, we're just packing Williams in this week. Uh-oh. And we got Powell speaking on Friday to finish out the week. So if your positions weren't wrecked enough on Friday, we got the man, the myth, the legend himself speaking on Friday. And the question I have for all of you is this: will he blink? And that's the question I also have for Williams. So we definitely have to keep an eye on that. I can't believe that they're coming out on Friday during market open times with no news around it. So it's just going to be all eyes on Powell. And you could actually get stagnation all week long in anticipation of Powell. And we're getting closer to the debt ceiling. It's just going to be a jam-packed week, guys. I am excited and ecstatic for this week because it's going to be a money-making week. This week has the potential to be a hot one. Definitely keep an eye on for Friday with these two powerhouses basically talking. So it's going to be fun, guys. This is going to be an ecstatic week, and I hope you're as excited as I am for this week. If not, throw in the comment section why you aren't. And with that, before we conclude, I'm going to address one comment from one of our viewers just to give you guys also a learning lesson with it, just so everyone's knowledge is shared. So this question is from Anthony, basically asking about a request is BX has been on a downtrend since November 21st. I'm guessing that's 2021 or November 21st of the last year. Seems to be consolidating for price action. This 79 to 80 range seems to be supported going back to May 21st. Looking at the weekly, 73, 74 seems to be another support, supply and demand hand in December 22 and March 21st. I used the fib tool beginning from a COVID March drop, and I'm finding that the price continues to reject off the 61.8 retracement. That's pretty much common, guys, about prices coming back and retracing 61% on the fib tool. 50 and 60 indexes usually, or ETFs, are about 50. Prices on stocks, 61.8% is a pretty good known value that stocks like to retrace to. Is just how fibs work. If you find a company that uses or follows a fib, it's a pretty accurate description of how the price is going to react. I would love to get your opinion on what you see, and from what I said above, maybe getting right or wrong about the chart. So let's take a look. So we're going to look up BX. So all right, so starting off, you were saying that you have a, let's see, you have a downtrend. Range is 70. Now it seems like the weekly support 73, 74. So you're looking at a weekly graph, and let's see price action in that area, 70, 70. Definitely seeing a area of price action that could be forming here, especially with this big move up. You haven't really retested that price action. However, if you're coming back to retest this price action, you're going to be below the 200 weekly moving average. So it could be bearish because you are going to basically be sandwiched in between. So if you come down here, you're going to break the support, be sandwiched in between it and the price action zone, and the price action zone can break sooner than the resistance of the 200 weekly. Once you break it, remember, support that is broken becomes resistance. So taking a look at your fib question, that it basically you drew it down from the COVID lows to where we are now, just getting a cursor up here. So it retraced 61.8%. Yeah, this makes sense. This was a so this is why it worked out to 61.8% retracement, is because this is basically a parabolic move, and I can actually argue that the parabolic move occurred here. So you'd be closer to that 70% retracement on the parabolicness, but again, 61.8 is pretty dead on of where it retraced. So now you basically are coming up right to that 50 mark. However, if I were looking at this, you're basically in the kangaroo. I wouldn't necessarily look at it as like a fib versus not a fib. So 74, 73, I do agree that it's support there. However, I would argue that you may even have support at the 78 to 77, this being where you had a big move up on volume right here. So this definitely could be an area, if we go to the daily just to see what happened in that location, I'd definitely be saying about right here. Like you're saying that 78 to 77 is probably going to be an area of support that I'd be looking at. What I don't like about the chart is that you're basically sandwiched in all these moving averages over here. And personally, this is just my personal opinion, is that you basically don't want to be sandwiched with all those moving averages, because you have a more probability to come back down to the 200 weekly. Could be forming a possible head and shoulders here. So to me, and also possibly a bear flag right there, which could bring you back down to this 200 weekly. My price target, I would say, would be that $76.82 region, which is your 200 weekly moving average. But other than that, I think using the fib on the big parabolic move is an excellent idea. If we assume that it's going to retrace this move about 61%, you're already below that retracement. But for me, I'd be more looking at to see if you had an A to B pattern for here, A to B, B to C, completing down 82. So I completed that one. So now I have to see if we have another A to B equals B to C here that completes down at the 72.50, which gives me more of a bearish intonation with the company versus a bullish intonation. So for me, I'd be looking at this 200 weekly. I'm going to jump over to Lux Algo just to see what it's telling me on this stock. So looking at this is why I like Lux Algo. It kind of does a lot of the work for me. You're in a price action zone right here at that $79 region, like you stated. And then basically 71 or 72, 73, 74, like you stated before, is the reversal zone plus the price action zone. So yes, it would be an interesting point there. However, taking into account where the moving averages are, I wouldn't necessarily like that. I do think that if this consolidation can get back above this trend of 86.44, it could be an interesting area to buy. Your MACD has actually crossed back over on the daily, and now we need to see if it gets back above that zero line. RSI is staying stagnant at 50, which it's a 50-50 split basically of where it wants to go. If I look at the weekly, so weekly basically price targeting zone here, we have the MACD trying to curl back towards one another, and it could, again, doesn't mean it has to, curl back up to it and see continuation. I may want to see the MACD just kind of play out a little bit before I necessarily would get in, but definitely this area of, like you said, 79 is basically seems to be a support. You had a price action there, and the 73, 74, and that, again, it could be another supply and demand area, but I don't recommend buying there just because you'd be below the 200 weekly moving average, and that just has more overall bearish intonations. If you hold, let's say I'm going to say 78, 68 range and continue up, then you could dollar cost average up. But right now it's kind of in that I really don't know where it's going to go. So I really would like that 200 weekly retest. If it retests it, it should bounce off on strong volume, find buyers there, and then continue higher. That's just my 2 cents in the whole grand scheme of things. How the company plays out and everything is yet to be seen. So if you guys have any questions like this, throw it down in the comment section below. I love answering questions like this, so just keep an eye on for that. And with that, guys, we're going to conclude today's video. Like if you like, comment, and subscribe. We really appreciate all that you guys do for us. If you have any questions or ticker recommendations, throw in the comment section below. If you want clarification on anything we covered, same thing, throw in the comment section. We always like interacting with our viewers. And I hope you have a wonderful rest of your weekend and a wonderful week, guys. It's going to be a jam-packed week. I cannot wait to see what Powell and Williams talk about, how the data comes out. It's just going to be a fun week. So hopefully you're as excited as I am. If not, throw in the comment section below why you're not. Maybe we can have a discussion and change your mind. So thank you very much for watching, and I hope you have a wonderful weekend.